Welcome to the S Corporation Basics mini lesson. We have a lot of content for you in this lesson, so I'm going to walk through it rather quickly, but I'm really excited to share this topic with you. Since we're going through a lot of information, if you have any questions or need additional help, make sure you go into the member community and post on the discussion in the discussion room. So happy to help out. Let's jump into S Corporation Basics. And an S Corporation is a hybrid type of entity that has some attributes of an LLC, some attributes of a corporation. We're going to talk about that formation, management, and asset protection. As I say on many of these mini lessons, we are looking at things from the tax planning and strategy perspective. Make sure that you have proper legal representation with you. As part of your board of directors, we always talk about that piece as well in Teaching Tax Law 101 and all over our ecosystem. We're going to talk about how S corporations are taxed, what the reporting looks like, and give you some IRS guidance and then some calls to action. All right, let's jump into the formation, management, and asset protection. S corporations are much more formal than an LLC, or especially a single member LLC or a sole proprietor. You are required to file formation documents with state taxing agencies. Most of them are online. Every state's a little different. You're going to have board of directors, officers, and annual reporting requirements. Most states do require that you have annual meetings and bylaws. So you're going to want to document that. Owners of a S Corp are called shareholders, and they own stock. S corporations have some very specific ownership requirements when it comes to how many owners you can have and who can own S Corp stock. So I'm going to point your attention here. You can only have 100 shareholders, and they're limited to U.S. citizens and residents. Now, there are some special rules with shareholders when it comes to family members and households, so definitely talk to your tax professional or attorney about that. Stock is limited to just one class. It's a little different than an LLC where you can have multiple different classes or types of ownership in the C Corp as well. So stock's limited to one class with equal rights of distribution and liquidation. Corps and LLCs can elect to be taxed as an S corporation by filing Form 2553. We're going to share that form with you. You raise capital in S Corp by selling stock. The entity is perpetual, so it goes on just like a regular corporation. Who's it best for? It's best for owners that want liability protection and companies funding fringe benefits and to avoid that double taxation that a C Corp negatively provides. Shareholders are typically not personally liable for the debts of the corporation. So keep in mind, an S corporation is something that an entity elects to be taxed as. That election is made either by an LLC or a C corporation. No taxes paid at the S Corp level. Again, income is taxed through shareholder of the entity. An S Corp files in Form 1120S. We're going to take a peek at some of that IRS guidance in a moment. In each shareholder. So each shareholder of the S Corp at the end of the year gets a Form K1. That K1 reports all of the tax attributes that eventually are reported on the personal tax return of each shareholder. The bookkeeping is more advanced. You do need double entry bookkeeping because the tax return requires a balance sheet. And any shareholder that's providing services to the company is required to be paid a reasonable compensation. Again, we have some additional content about reasonable compensation, and that gets paid on a W-2. If you're eligible for excludable fringe benefits, the taxable benefits are reported on that W-2. So a S Corp shareholder that's doing service for the business is going to receive a W-2 and a K-1. That's why we call it a hybrid entity, and those employee benefits will be reported on the W-2. The nice thing with the S Corp, the biggest advantage, is that distributions of profit are not subject to self-employment tax. And S Corps must generally use the same year as its owners. Finally, on the tax reporting and fringe benefits, shareholders may qualify for that 20% 199A QBI deduction. Make sure you check that content out separately. We have a mini lesson on that. Let's look at that IRS guidance. What you're looking at now is a Form 2553. This is just the first page, but this is the form that you file when an entity wants to elect to be taxed as an S Corp. This needs to be done within 75 days of formation or a tax year. So for instance, if you make this election on January 31st of 2023, you can make that election effective January 1st of 2023. So the first 75 days of any year, you can make your S Corp election effective the first day of the year, or within 75 days of a new entity forming.
John here from Teaching Tax Flow. I wanted to thank you for watching this video. We literally have hundreds of hours of content between podcasts, webinars, videos just like this built specifically for you, the taxpayer. Whether you're a full-time employee, you're a freelancer, you're a contractor in some other sense, or you're thinking about getting into business for yourself, everything here at Teaching Tax Flow is perfect for you, basically going off of the roadmap provided by the IRS to legally and ethically reduce the taxes paid over your lifetime. So be sure to subscribe to this channel and connect with Teaching Tax Flow, and we will see everybody very soon.